clarification coming through as well. But let's move forward and let's get into an exclusive conversation now. Jonathan Garner is Chief Asia and Emerging Markets Equity Strategist at Morgan Stanley, and he's joining us on the channel now. Jonathan, good morning. It's a pleasure having you here on the program as always. Prashant this side. I want to start with growth, which seems to have hit a bit of a road bump recently, Jonathan. Nominal growth has dropped to 8%. That's what corporate profits track. What's the sense, Jonathan, and how should we read this? You've been a big bull on India, best performing market, best growth prospects, etc. But it's a bit disappointing. I mean, we're in the 5% handle now, real growth.
Yes, you're right, and we've been watching that closely. I should say we remain constructive India. We are overweight. We believe we're in a secular bull market, but we have had this cyclical slowdown. And I think the debate with investors is, when does the kind of growth pick up again? And the view that we are getting from our economics team and from Ridham Desai, our strategist, is there were some quite unique features behind the slowdown. We obviously had the election. We then had a lot of rain in August. We had some changes in the lunar calendar. And what we're now actually seeing is the early signs of a pickup. And we do think that government fiscal spending will come to the fore again. And we are optimistic that in the first half of the calendar year next year, so that is the second half of the financial year, as it were, in India, as we go through to the end of March and then the end of June, we will see a pickup. And so we are above consensus on earnings growth. Those earnings estimates have come down, but we think earnings growth moves back up again. And we have a 93,000 target for Sensex for December of 2025, which means it's got more upside than pretty well anywhere else other than Japan in our coverage.
Jonathan, what does it mean for, two questions actually. Does growth need a bit of help? You said fiscal on the government side, RBI today, by the way, and we'll hear from them as well. There'll be an acknowledgement. What they do about it, we'll have to wait and watch. Do you think we need a bit of a push now, both from the monetary and fiscal side? And is that certainly going to be possible with what's happening globally, in the US especially?
Oh, absolutely, because the US rates environment is softening. Rates are coming down. I don't think the monetary side is as important as the fiscal spending side, which will come to the fore. But on the underlying consumer and industrial investment cycle is also, we think, intact and very much in contrast with what's going on in China, which is in structural deflation. So we do think this is a sort of two-quarter cyclical slowdown. It's not likely anything worse than that.
Okay. Jonathan, hi. Great to have you on the program. And it's good to hear that you're still keeping the faith, so you're not too perturbed about this last GDP print. But having said that, a lot of people here in India are arguing for, more stimulus, monetary stimulus for sure. CRR cuts, repo rate cuts. How important is that in your projections for the Indian equity market? What are you penciling in from the monetary side as of now?
Well, as I said in answer to the previous question, relatively little, maybe 50 basis points off rates. But these growth numbers that India is still producing are still just about the best in the world of any major economies. I mean, if you look at the US, growth is slowing. If you look at some of the markets that we're negative on, for example, Korea, that's in the news right now, we're predicting like a one handle on GDP growth in Korea next year. And the markets that are more exposed to sectors like autos and semiconductors globally, where there's a cyclical slowdown underway, they are likely more pressured and in many cases actually are starting to underperform. So I really wouldn't be too alarmed on the situation in India. It looks good to us.
That's, again, like I'm saying, from our perspective, that's really reassuring to hear. But on the US, if you could just expand on that, because the narrative of the last two to 3 weeks, actually since the 5th of November, has been this whole American exceptionalism, right? Just buy America, yes. Everything America. So are you saying that that's gotten a little excessive?
Well, our key overweights globally are the US itself, Japan, and India. those three effectively. And we are most cautious on Europe, on global EM, and within EM on Korea and China. They're our biggest underweights. So India sits there as one of our top three preferred markets globally. It's true that the US is getting a lot of attention, and one of the themes that we talk about in the emerging space is that emerging markets as a whole doesn't really make sense as an asset class anymore. We've basically said for some time that you need to pick your individual spots, and India is one of the places that we like. There are others that we like that are going through idiosyncratic positive stories, South Africa, for example, and parts of Southeast Asia. But I think that it's not so much the case as will money move out of the US to buy EM. It's more like, can you identify really quite a unique opportunity, which we think India represents, to participate in a structural bull market? Do remember that earnings in India have been growing around about 15% per annum compound dollar over the last 3 or 4 years. Slow down right now, then hopefully that resumes. And that's way, way better than emerging markets in aggregate that's struggling to deliver any earnings growth, or China, where earnings growth are actually falling.
Hi, Jonathan. Good morning and good to see you in. This is Nigel on this side. You know, Jonathan, the FI selling picked up big time in the last couple of months. And we are thanking our stars that, in fact, that slowed down at least in the last few days. Do you think bulk of that FI selling is done? Because the FI holding in the Indian markets has come down to the lowest we've seen in the last 10 years or so. Your take?
I think you're referring to the percentage of the market owned by FIIs rather than domestic investors. And certainly one of the reasons we're bullish India is the domestic investor bid. You know, the young demographic getting formal sector jobs, interested in their country's future, investing in stocks. The FIIs you're referring to, that tends to be related to the legacy situation in relation to active emerging equity funds, where you're getting these redemptions. And to some extent, a short-term tactical bounce in China around about the middle of September, around about the time that this growth slowdown in India also became visible. However, that tactical bounce in China, in our view, is fading and likely to fade quite badly as the structurally adverse growth drivers reassert themselves. Meanwhile, with the IPO, the secondary issuance, and the underlying outperformance we think of India, its weight in EM is rising, but it's also, for the first time ever, coming on the radar screens of truly global investors. If you look at the ACWI EMI index or broad equity indices, it's up to about 2%. And at that level, truly global investors start to make trips to India. They start to look at the first 1 or 2 stocks that they can add to a global portfolio. And that's where the future lies. To some extent, it's what happened a decade ago for China when the major China internet names found their way into global portfolios. That's now reversing, but that story lies ahead for India.
Jonathan, you know, you made the growth comparison here vis-a-vis some of the other emerging markets. The sobering thought, though, is that we're a $3 trillion economy, and growth is now coming in the 5% handle. China is almost 19 trillion, and last year growth was 5%. So actually, I mean, from an India perspective, we've got no business slowing down, right? I mean, like this, to drop to, we must do all we can to sort of, you know, sustain high rates of growth for a long period of time, because I guess that's what a lot of this thesis is dependent on, you know, higher consumption and a bigger consuming class.
Yeah, so those numbers you just quoted are, I guess you're thinking about real GDP growth numbers on official estimates, okay? If you actually look at what's really going on in terms of nominal growth, even on official estimates, Indian nominal GDP growth is 2.5 times that of China, still is, because you've got the real growth plus the inflation. And if you look at what's actually going on the ground, what multinationals are telling you about their businesses and what corporate earnings is actually compounding at, as I said, Indian corporate earnings are compounding easily in double digits at the moment in dollars, and Chinese corporate earnings are struggling to grow at all. So it is not the case, frankly speaking, that India's economy is growing at the same pace of China's. That's not what's happening in reality at all.
There is the inflation component, no, point taken. Jonathan, just to take that point forward with regards to China, as we head into 25, I mean, of course, 20th is inauguration in the US. But already, I mean, they've started moving on various things and giving out indications, the Trump administration, what they want to do. Do you think, you know, the policies towards China will be as adversarial which benefits this China plus one, and India has been a beneficiary of that over the last couple of years. Or maybe this is a bit of a reset with Musk at Mr. Trump's side. Maybe, it need not be. It's a reset, and maybe in a slightly incrementally positive way. What's your sense? That's not consensus, though. Go on.
Yeah, I think this is administration that is likely to materially increase tariffs and non-tariff barriers on China. We're anticipating over 18 months the effective tariff on China from the US goes from about 12% to 36%. And that will add to China's growth difficulties and probably also pressure the currency lower as China responds to that. And indeed, one of the long-run themes when we go back to this dollar earnings growth that I've been emphasizing is the Indian rupee is now more stable than the Chinese renminbi. There's a role reversal there. And India is very unlikely to suffer the same kind of trade pressure for all sorts of reasons as China will from the incoming administration. So that is an important headwind, and it's part of our thinking. And it's why our China economist actually expects China growth to weaken even further next year. Whereas I just said for India, we expect a cyclical pickup to resume.
Which also brings me to the next question in terms of what to play in the India market, Jonathan, and what you like. A lot of people will want to believe that China's loss will probably be India's gain, because we saw that play out at least in COVID, right? COVID, when there was supply chain disruption, a lot of the Indian API manufacturers, those who are making these bulk drugs, chemicals, those companies started doing really well here in India. But that was a different time. Now we're talking tariff wars. So again, do you expect any China plus one benefits at all for India? And beyond this, what are the other top themes that you'll continue to like here?
So working with Ridham and the team, we are overweight financials. That's actually a global trade at Morgan Stanley. We like financials pretty well everywhere other than in China. We also are overweight consumer discretionary in India and industrials. And we like the IT services names. They're very engaged and working hard on the AI rollout globally. And we're deep now into the shift from enablers to adoption. So adoption basically is AI being adopted by major software as services firms, major global financial services firms. So the India players in that sector are very engaged in all of that. And we are underweight the defensives and certain other areas like energy and healthcare. And we're pretty happy with that approach. I think you were just mentioning before I came on your show that the banks index in India is basically almost back at the high already. And we're seeing that bank's outperformance in many markets.
Okay, all right. Thanks a lot, Jonathan, for joining in and giving us your quick take on how you see the global markets shape up, particularly India. You're sounding rather optimistic on prospects, 93,000 on the Sensex. So that's a good upside from these levels.
Thank you.